This is my conversation with Jeff Brines, a finance professional and mountain bike racer who's been analyzing the cycling industry through a very unique lens. From his base in Jackson Hole, Wyoming, Jeff brings venture capital and private equity expertise to decode what's really happening with cycling brands. We dive deep into the YT industry's collapse and resurrection, exploring how a direct-to-consumer darling went from insolvency to a potential comeback under its original founder. Jeff explains the fundamental differences between private equity and venture capital, and why YT's spectacular implosion was visible to anyone reading the financial tea leaves. But the real revelation is Jeff's barbell hypothesis, the idea that the cycling market is splitting into two thriving extremes while the middle haul is out. Value bikes under 4,000 and premium and custom builds above 15,000 both are doing well, but the 6,000 to 8,000 sweet spot, it's disappearing fast. We explore why this is happening, what this means for brands, and how Chinese manufacturers are positioning themselves to capitalize on this shift. This is the Business of Cycling podcast. So Jeff Brines, thank you so much for coming on. I'm really excited to have kind of a different perspective. I know you've got some industry experience, you've got some investment experience. You had come on my radar with some writing that you were doing, some writing on LinkedIn, and I reached out. We kind of connected. So really happy to have you on. Where does this podcast find you today?
Hey, thanks, Wyatt. Really appreciate the opportunity. I am in a newly snowy, and by that I mean it just started snowing in Jackson Hole, Wyoming, so just outside of Yellowstone. If you're not familiar with the town.
Awesome. So I don't know, man. Just to get started, maybe you just want to tell me where you're from, your upbringing, your
Sure,
studies, that kind of thing.
sure.
Origin
Yeah,
story.
I'll carve it into two buckets. So I've got kind of
Okay.
my bike and sporting background, which frankly has been a huge part of my life, and then I've got my professional background as well. So I'll start with the professional one. I grew up in Colorado, ended up at the University of Colorado studying finance, graduated with all intentions to go work in the real estate industry, specifically investing in properties and doing development. But the year was 2007, and we can all imagine how that went, which was not well. So I took a little time and decided to come to Jackson Hole, got hurt, moved away, did everything I could to kind of deal with the concussion that I've talked about in other podcasts. It was pretty challenging in my early 20s. Kind of bounced back from that and found myself back in Jackson Hole working for a little startup in the qualitative financial intelligence space. So what does that mean? Well, effectively, we are a service that would provide you as a trader or a portfolio manager news. And one of the ways I break this down for people is we were essentially like Pink Bike or VitalMTB to the finance crowd, in that there's all this news out there, and we would try to aggregate what we thought was most important and material to our group of subscribers. Now, it is a lot different in that we were really aggregating what we considered to be material, not what we liked. Liking had nothing to do with whether or not we pushed something to the subscriber base. But I worked there for a number of years. On the side, tried to build my first startup, which was a very similar play as VitalMTB in the ski industry. Learned a lot. That's kind of what started my interest in computer science and technology. Ended up moving from that career to I'm skipping a lot, but moved to a venture-backed startup around 2020. That was my first real experience having been a part of the more traditional startup route. Street Account, where I was before, was definitely a startup, but it was very different in that it was bootstrapped, no venture capital involved, that sort of thing. This was like the who's who of venture capital was in it. I quickly rose to kind of second in command there, which was a really great experience. Unfortunately, the company did blow up in 2023. From there, started consulting. And because of my network being so strong in the outdoor industry, a lot of outdoor brands started to approach me. So I actually partnered with my dad, who has really had a huge influence on my life. He is what I'd consider to be an old school CFO. So he's got all of the blocking and tackling all the way down to the accounting level. And I'm more of a finance guy with the technology spice, if you will. I'm studying AI and ML at UT Austin right now, and I have my own startup that I am fundraising around. So that is my story professionally, kind of in a nutshell. Now, on the bike side, which again has been a huge part of my life, I started racing when I was 14, became a shop rat at 15, and really raced ever since. I mean, I definitely don't race nearly as much now, but even my startup is in the racing space. I'm trying to really allow everybody to race using the device in their pocket. So huge into racing, and as a result of that, that's how I got on Vital's radar. Sean Spomer was actually a photographer back when I was a junior, and we became friends. So I ended up doing some product testing, editorial, technical editor type stuff, not editor, but editorial stuff, and have loosely been in the game, for with other product testing initiatives through SRAM or Fox. Buddies have been engineers and have moonlighted at shops from time to time when they need help. So I've never not been in the industry, but I've more had like a toe or a foot dipped in, not the whole thing, until more recently when my consulting has really brought a number of clients from the industry.
And you said you're from Colorado originally,
Correct.
and you've got a pretty deep experience in finance, and you've worked for a few different startups and did consulting in finance. But throughout that time, like you were mentioning, you've kind of had your toe, and you do some writing for which publication do you write for?
So I have my own Substack, which has kind of started to
Sure,
take off,
of
surprisingly.
course.
And really where I've just kind of enjoyed the intellectual discourse we've been able to foster over at VitalMTB. There's been a great thread. I started a number of years back, actually, when the startup I was with blew up. I started to see, kind of through the fog of everything happening, and it was very clear at this time that the zero interest rate environment had created a situation where there was a ton of funding that chased deals that frankly weren't that good. And that wasn't just unique to the tech space or the finance space or whatever. That was clearly going to impact the bike space as well. And when you double that with the impact of COVID, I started writing about that there. And it's, I think as of today, 126 pages long of, kind of me getting to fill in this kind of cool role as professor and answer questions and give some thoughts as to what's happening. And one thing I caution myself here is like I obviously enjoy the intellectual components of the industry, and sometimes I do so in a way that might seem crass and that I forget. I don't forget. I just don't acknowledge that have lost their jobs, myself included, in a different industry. There's nothing worse than job loss. There's nothing worse than like company destruction if you're a founder or something like that. I just want to be clear that I'm not making light of that, as intellectual as I may get here.
No. I think what you're saying is you had this industry knowledge, or you have this finance knowledge, finance experience, which you continue to kind of foster, and you've been able to sort of apply that point of view to the cycling by contributing to Vital. And I just noticed that you've been writing a bit about the YT blow up and reassembly, I guess you could say.
Yeah, yeah,
Can we dive into that? I want to dive into that. I
yeah.
want to
I
I want to
mean,
hear your take on that, because maybe you want to just give like the explain it to me like I'm 5 years old version of that, because I'm
sure.
not saying that we have 5-year-olds, but I'm just saying that people that maybe aren't as versed in finance, like from your standpoint, what happened and what is happening. Hey, it's Wyatt here. So here's a stat that should get every cycling brand's attention. 65% of all product searches now begin on Amazon. Not your website, not retailer sites, Amazon. Here's a question for any brand managers or business owners listening. Do you know who's selling your brand products on Amazon right now? Chances are your distributors and dealers are already there. And if you're not actively managing that presence, you're losing control of pricing, brand story, and your customer experience. So my agency worked with cycling brands, and we help build and manage their Amazon presence, from listing optimization to driving sales, as well as Amazon advertising. We've helped brands increase their revenue by 50 to 70% in just the first year. So if you're interested, you can drop me an email at wyatt@velomedia.io. That's wyatt@velomedia.io. Now let's get back to the show.
Sure. So, this is a very unique one only because YT, for whatever reason, and I need to be clear, I'm not an expert on the regulatory environment in Germany, but YT has been filing their financials up until 2022. At 2023 onward, we have nothing. But up until 2022, we actually have a fairly decent lens into the performance of the company. That's very unique. Outside the publicly traded companies such as Fox, we don't get that kind of look. So, this was kind of a microcosm of what I was seeing happen all in one company with public financials to some extent. And now we're seeing this kind of, I don't know what to call it, like this almost reality TV show unfold in real time. So to explain what happened, YT, we all know, was a direct to consumer, is a direct to consumer bicycle brand, had grown in the 2010s, and in 2020 sold to private equity. Then it came out this year that they were effectively insolvent and had filed for the German equivalent of Chapter 11.
Right.
Again, why this was frankly, quote unquote, juicy is because we had the financials, and YT always stood out as a brand that was spending beyond their means relative to the margin they were likely capturing.
Why do you say that? Why do you say that?
So there's a couple examples here where, they hired Christopher Walken to do a commercial. They had a full-on World Cup race team, which you can do clearly as a smaller company, but it is expensive and it does require a lot of diligence around how you're managing your financials.
Gosh,
And
yeah.
it really seemed like, boy, two things are going to be really hard to be true at the same time here. They're not big enough to be like a Specialized or a Trek or a Giant where they're moving, some bikes at low margin, but they're moving so many of them it makes up for it. And obviously they have the higher margin bikes too, and they have the race team. In this case, it's like, okay, this is a relatively small company that's selling bikes at sometimes such good pricing. Myself having shop deals and whatnot, I would consider buying one of their bikes just for the parts and sell the frame or whatever. And I was like, this is almost better than wholesale at times. How is this working? So the only thing that I could make sense of is again, it's a low margin business, which turns out, if you look at their financials, is very true.
So
You know,
it's sort of like your spidey sense from like being in business, knowing the industry, your spidey sense told you that they were punching above their weight in terms of the investments that they were making, and that it was just kind of like you were like the chickens have to come home to roost. I don't know how you say that, but like
you got it.
something doesn't add up here, and so
Yeah.
and in reality, it looks like that was the case.
Yeah, that's exactly right. And there's a couple other things that play into this. It is easier to operate at a low margin if interest rates are zero. And I know that, even if they're not borrowing much, all capital obviously is impacted by what interest rates are doing. So,
Sure.
AKA, we all understand that. So in this case, it's like as interest rates started to creep up, it became extra hard to operate in a low margin business, especially one where you're spending a lot. I mean, obviously that's impacting net margin. It was just one of those. Correct. The chickens came home to roost, and it has blown up in a very spectacular and public fashion.
Yeah,
Um,
because initially, I don't know if people remember, but in the summertime they said, okay, so we're going to enter self-administration. I had kind of written a little bit about it, and everybody thought, oh, well, somebody will buy it. And then it turns out that nobody bought it, and everybody was sent home from the corporate office. And then shortly thereafter, the original founder who had liquidated to the private equity firm, Marcus Flossman, bought the assets back from liquidation. Now, we don't know all of the details around that, but it sounds like, so from what I understand, and correct me if I'm wrong, but the private equity company that owned it was like, this thing isn't even worth keeping anymore. We're just going to let it die. Like literally, we're going to walk away, because for us to get any money back out of it, we would have to put more money into it. We don't want to do that. We're just going to just call it good and walk away. That's
yeah,
what happens, right? And when a company just basically is shuttered like that.
that is correct. And one thing that has been very popular in my writing is trying to unpack the difference between, say, private equity and venture capital. Now, technically, venture capital is a form of private equity. We don't need to get too specific. They are different forms of, they are different asset classes. And private equity, broadly speaking, when deployed, that's it. You go buy a company and you don't keep adding money to the company. Venture capital is the opposite of that. So I think people sometimes get confused and they're like, well, of course there is money needed. It's just like XYZ tech company that kept raising money. There's a big difference between these types of companies. So when a private equity company is in the position of needing to inject capital into a business,
To keep
they
it
have to
alive.
to keep it alive, correct.
Yeah.
They're in a very difficult position of going, wait a minute, are we just throwing good money after bad? And all the while knowing, for your listeners that may or may not know anything about this, the whole point of private equity is to deploy the capital and then
Get
return money to
yeah,
their
yeah,
LPs
yeah,
in roughly a 10-year time horizon.
right.
So this just makes it extra hard. We got to hit an IRR, we have to hit a return, and we have to do it faster now because we're deploying, bad money
Because we
after
have
whatever.
more debt.
Exactly.
Like, so
We
they were just accumulating debt, and so at some point they say, look, for the people that give us money to invest, the best possible scenario right now is just to cut our losses and move on.
Correct. And it's going to be equity. They're just diluting their own stake effectively. So it's like in order to recoup this, we have to sell it at a higher valuation in the future, or this is just a bad deal. And somebody stepped in and was probably like, I mean, I know Marcus just told the story of him actually getting the private equity firm to agree to inject a certain amount of capital. I think he was using made up numbers, so I'm not even going to quote him, but to just do that in 2025 is very impressive, to be honest. I think a number of private equity firms would just say, sorry, we're going to write it off to a zero and move on. Which, again, it's not as normal in private equity to go to mark a company as a zero. It happens. Venture capital, that's very normal. You expect one or two companies in your 10 or 12 company portfolio to make it. Whereas in private equity, the expectation is every company you buy makes it. It's just to what extent. So it's not good when it goes to a zero. And it's a little bit interesting too that when there was kind of this go shop period in self-administration, YT was basically not sought after. I think there was one company that wanted to buy the assets and effectively spin everything off, liquidate everything, and move on. They saw like kind of a distressed situation they could make money on,
Right.
and that was it. And that's what Marcus was calling out as, this is crazy, blah, blah, blah. Now, I think, again, one of the reasons this is very interesting, Marcus himself has said this, he's not a finance guy, he's not a logistics guy. Well, it turns out underneath it all, that's all YT is. I mean, I get the brand is very important, and that is a huge part of their moat. They've done a great job fostering this image and all of that. But at the end of the day, you got to still operate the company to make money,
Well,
and
yeah,
that's
and
what is. Go ahead.
that's
No, go ahead.
that's what doesn't hold water. It's like, I mean, from the outside, if you really kind of look at it objectively, it's like, well, the smart money says no, it's not worth anything.
Correct. And there's always times that, there's this Peter Thiel quote where you have to be a contrarian and you have to be right to be successful. So, maybe Marcus is right and there was value
No,
there that
sure, of
nobody
course
else
he
is
can. I
seeing.
mean,
Yeah,
he'll be able to
of
start
course.
over. Like, can you explain just briefly what you think is going to happen next?
Sure. So this is my controversial take to a degree where I can kind of paint, I don't mean, I'm not going to even do it here as much, but I've kind of painted Marcus as almost a villain. And I don't mean to do that, but it's like one thing I haven't seen a lot of is accountability from him. But now he's in this position and we don't know what the balance sheet looks like going forward. We don't know the price he paid. We don't know really a lot of the inner workings, but there is a hypothetical world where he's in a great situation now with the brand kind of free and clear from a
Because
balance sheet perspective. Yeah.
he doesn't have to pay the creditors. Like, no, the
That
creditors don't get anything from that.
that more than likely, what it seems like, and this is speculation, but I have good reason to believe this, the bankruptcy estate is where the creditors lay. That's where all of they're being made whole as part of that, whatever's left there. And a lot of this sounds like it's going to be written off to a zero for some of these guys, including the private equity fund. So at the end of the day, from what I do know about, American bankruptcy law, but definitely German bankruptcy law as well, is they don't let you go forward unless you have a plan that they think is likely to be successful in the future.
But could
AKA, go ahead.
could he have just bought the assets from the bankruptcy? Isn't that what happened? He bought it from the
Yeah.
bankruptcy
Yeah,
court,
that's
and
that the,
so
the parts, some of the assets, right? And we don't
right,
know what was
the
carried
brand,
forward, what wasn't,
right?
right? Exactly. So my point is like I would actually love to be a part of the team to drive this thing forward because I think he's in a great spot all of a sudden if he pulls the right levers. You just can't, what he can't do is continue operating the company as he has in the past, which, if history is a guide, likely will be the case. We don't know, but there is a really good opportunity here. One thing I've talked about extensively elsewhere is I feel in 2025, one of the most difficult things to build is a brand and broadly speaking, distribution. I don't just mean logistics. I
Yeah,
mean people knowing your
absolutely.
brand. It's very, very I think people underappreciate what it takes, what it's always taken to build a brand, but now it's hyper competitive to get your name out there. He's got that. And he's got a good product. I think that's worth noting. Like everybody I know that's ridden YT stuff, I have not. generally have good things to say about it. So he's got a good product. There is definitely some diamond kind of in the rough type of thing, but you've got to be as I've said elsewhere, diligent, disciplined operator to make this work, which is going to require SKU cutting. It's going to require, expense cutting. You're going to have to be really lean. You're going to have to really know what makes your quote unquote beer taste better. That's the old Bezos quote. Really know what makes you special. Double down on that and make sure you're not taking extravagant type of expenditures you don't need to take. So it's going to take a lot of
Discipline.
really, yeah, exactly. I think discipline is the name of the game, and as one of my colleagues said, Marcus has not shown that to be his strong suit. So we'll have to wait and see. This is where that situation lies at the moment.
So yeah, like you said, I mean, this is a developing story, and hopefully, I'm in touch with him. Hopefully he'll come on, and we'll be able to discuss kind of what his plans are. But yeah, hopefully he can make that work. Again, I see that direct to consumer, it has a ceiling. Kind of what I'm seeing, a pretty defined ceiling in a sense that, I mean, what I'm sort of learning here talking to people is that if you're going to buy a bike that's 7 or 8 or 9 grand and you're riding it along and it starts making a funny sound, like, what are you going to do? You're going to send that back because it's making a funny sound? Like, who's going to
Right.
pay for that?
Right.
So I think having a distribution network, I mean, unless you have an incredibly huge value that you're willing to take that chance, the D2C model has some serious limitations. I mean, that's just it. And you can see that Canyon's building out that network because the market is saying, look, we love your bikes and everything, but we want to be able to take it somewhere where someone can help us and look at it and fix it, if an expert. So that's kind of where that stands at this moment, and we'll be keeping up on that.
Yeah, and just to put a bow on that one, because I think it's really important what you just said. Again, YT has really built a brand off of two things in my mind, maybe more than two, but two big things, which is at the end of the day, great pricing and great performance together. If you take one of those two things and change it, I don't think there's much of anything to talk about anymore. So by going omni-channel, as he's kind of talked about, that means he's got to find margin for the other players involved, which is going to challenge him and it's going to put him in the same box as Specialized and the other guys.
Sure.
So, I think a great model here, a great mental model for all of us is transition. I've been a big fan of transition since their inception, really. And I can tell you, it seems like they've struggled the last few years because they've had no choice, because they've got like a hybrid D2C plus dealer network model. Their pricing is not what it once was. It used to be like, oh man, transition bikes are just the best deals out there next to a YT or something like that, but they're close. Now it's like you're paying a good clip more for the same type of bike. And I think YT might find themselves in the same situation. The difference is Transition's built that network over a long time, the dealer network, where I think a lot of people see that brand in a way where they're willing to pay that little bit of extra. For one reason, they've got a great warranty program over there. I've broken a lot of stuff over the years, and they always have me back riding within the same week, and I can handle it on my own. YT, this has been an Achilles heel for them, so they're going to have to navigate, like, it's kind of a fundamental change in the way that business looks by changing from D2C to other forms of selling and distribution and whatnot. I, I don't have an answer here. I don't, but I do agree that this will be a challenge they have to wrangle in the future.
So kind of switching it up, the reason that I reached out was, obviously around your commentary around the YT, because you were writing some really nice, succinct kind of diving into this topic because of your experience and because of your background in finance, which was super interesting to me, and that's kind of why I reached out. And then there was another topic that I had sort of read, and that was another thing that I wanted to speak about, was this concept around the barbell shaped recovery. Is that what you call it?
Yeah, it's a mental model more than anything. So the barbell mental model, or you can call it the barbell hypothesis. It's a framing of things around you in life. It's a way to abstract reality down to something we can understand. And I'll be honest, I first heard about this, I believe through Mark Andreessen talking about the size of venture funds, and I won't go into that. But ultimately, what I started to realize is there's this grouping that's occurring right now in the modern era, where you start to see grouping at one end of the extreme and the other end of the extreme. AKA in the bike industry, we're seeing a lot of grouping on the value end. So, oh, and to a degree, YT is part of this, where you're seeing like amazing bikes at, let's call it mountain bikes. So I'm going to use dollars here. $3,500. You can get an amazing high performing bike. Conversely, you can if you're of the wealth or you have the money, you can go spend, I don't know, upwards at $20,000 now on an e-bike. And both of these sides of the business seem to be doing quite well. Maybe not the $20,000 e-bike, but custom road bikes, for instance, they're doing fine. Moots is doing fine. We could, I'm sure, talk about a number of road brands that the top end is doing just fine. Although I think we could all agree you don't get a ton more performance as you go up in pricing, but there's still healthy demand up there. What is hollowing out right now is that middle. And what's interesting is that middle is really where I came into the sport as a racer. It was like, man, I can't afford the top of the line, but I could kind of get close to that performance for, what is today's dollars, like $7,000. I don't, even as a racer now, I'm more of an enduro guy, but like I usually start at the bottom. I buy kind of a value bike, upgrade what's needed, and I don't feel like it's holding me back even a little bit. So there's a lot of reasons I think we're starting to see this grouping. One of the big reasons is the rate of technology's progress in the sport, mountain biking specifically. It's just slowed significantly. So again, it's there's less of a reason to spend more than X if you're money constrained. And if you're a brand positioning a product kind of in that middle zone, it's like, why is nobody buying it? We were kind of sold the wrong thing when we were younger. It's like we were kind of told like the Goldilocks zone is where you want to be. It's not too hot, it's not too cold, it's right in the middle. That's always a safe play. I'm going to say that counterintuitively going forward, I think we're going to see less and less of that middle zone playing well. There's always going to be exceptions to this, but I think we're going to see this for a lot of reasons, again, continue to hollow out.
And so from that standpoint, you're saying, and I mean, kind of what is your point of reference on this? This is like, what is causing this in your opinion?
Yeah, so like I said, causing this is a couple of big things. Like I said, first thing is just the net utility you get for every dollar spent past a point is just less and less than ever before. So I don't know what that line is, but it's definitely less than $5,000. It's probably more than $3,000 for a complete bike. But this also extends to componentry. Great example. I can go buy a holdover Fox 38 for probably $500. Or I can go buy the Fox Podium for $2,000. I actually own both, and I can tell you right now, I actually prefer the 38. But the big point here is you get a ton of performance on that bottom end of the curve. The Podium's selling out, so it's doing just fine. This is a great articulation of what I'm trying to say is like you're seeing both sides of that with a ton of demand. What you're not seeing a ton of demand for is the $1,100 fork. The kind of almost bespoke, awesome thing. I mean, another great example on the suspension side would be Intend. They're, a very high-end German, very well-engineered suspension product, and they're almost always out of stock. And we're talking, I think the lowest price one they offer is 1,800 euros, something like that. So that's a great example. Like there's plenty of demand there, and there's plenty of demand at the bottom end, but that middle end is just like if you got the money to spend $1,100 on a fork, you probably got the additional $600 or $700 to go to that high end thing. And it's also kind of one of those things where
That there's sort of a homogenization in terms of performance is part of it. Are there also some economic factors like that effectively
yeah.
the middle class
Yeah.
is feeling the pinch here? Is that another aspect that that may be contributing to this?
I'm fairly certain it was Lester Thoreau. He's an MIT economist that actually kind of had the barbell hypothesis idea in the first place in the 80s, and he was talking exactly about the middle class and this expectation the middle class will continue to hollow out. I could have that wrong, but I'm pretty sure that's where it came from. Demographic shifts are a big driver of this. So you've got kind of two groups of people in the United States right now. You've got, and broadly in the world, you've got kind of asset owners and not asset owners. If you're not an asset owner, that means you're probably working hourly. You are, or paycheck to paycheck, that sort of thing. And you don't, as costs go up, you don't feel wealthier. You feel like, oh my God, this is really hard. Those types of people are always going to seek out the most value for or for the least amount of money. Conversely, you have those that are exposed to the stock market, to equities, to investments, that sort of thing, and they're feeling more and more wealthy as time goes on. The S&P 500 has done very well the last few years. You feel very wealthy. As a result, you feel totally comfortable probably spending a lot more money on a bike than you might otherwise feel comfortable spending. So because you're getting that schism right now, I think that's a big driver behind this. I really think that
Sure,
um,
yeah.
go
And
ahead.
this kind of the secular kind of or the I'm not the secular, but the changes in like the fact that the middle class is under sort of pressure because capital always wins, at least in our in our society.
Correct.
It's the capital will continue to extract up, and then the middle class will probably be there's probably getting some pressure down, which isn't my opinion. That's effectively what's happening. And so just that sort of pressure that's happening in the middle class is just like you said, sort of hollowing it out. So brands are probably seeing success from this barbell sort of concept where on the high end they can invest. And I think what I see also is investing in hero products, not only for the fact that there is that the sort of the ultra wealthy is a class of an economic class of people that is actually getting healthier in terms of
Right.
their wealth, but that also can trickle down in terms of visibility. So I think it's easy for brands that want to invest in those really high end enthusiast products. I see this is because it does have a lot of knock-on effects in terms of like it improves the visibility of your brand, it improves the positioning of your brand, and so it's kind of a win-win from that regard. So I think there's also some branding nature for that, especially for brands that want to distinguish themselves. And then from an entry level point, like I guess I don't know, I would like to understand like how should brands be approaching this fact in your opinion?
Yeah. Yeah. So this goes to one of my favorite finance papers of all time, if not my favorite finance paper, which is called Measuring the Moat. It's kind of a Buffettism by finance professor now at Columbia, Michael Mauboussin. And in it, he does this great job articulating how the size of your moat, and I'll get into that in a second, really dictates the pricing power you have and the margin you can really drive on the product. So a great example of this would be airlines. We can all agree, airlines are largely just driven off price. So what happens in the airline industry? Well, your net margin you gain as a company effectively is your cost of capital plus like a teeny tiny bit to run the company because it's all about price at the end of the day. Now, on the private jet side of things, it's the exact opposite. It's all about the experience and margins are healthy. So I think this is a great articulation. If you're a brand, you got to know what is your moat? What is your special sauce? And for a lot of these bigger companies, they can play the pricing power, or I'm sorry, they can play the volume game to make lower margins really work. So only they really know if they have a good finance team. What net margin do we really have to sell this product at to be a durable, sustainable company? And that number as a larger company is obviously going to be a lot smaller than a smaller company. If you're a smaller company, maybe your moat is like, you're one of these, you're like an Atherton, you're doing custom, high-end 3D printed, really cool. They've got like a technical edge that warrants the additional money charged, and they can charge a lot more, and they don't need to play the volume game. But you really need to know if you're going to go play on price, can you sell enough of your product to make your brand work, your company work? Can you pay everybody's salary? That's where I think YT was an interesting case study. So you first got to know what your moat is, then you can start to position your product. Now, obviously, there are companies that can do both, like Specialized. They have value oriented bikes in their lineup, and they have really high end bikes in their lineup. I do unfortunately think this consolidation toward the bigger brands will continue for obvious reasons. They have more capital to do more things. This is common in really every industry. That doesn't mean if you're a smaller player, you're screwed. It just means you need to be more precise with your product, at least in my eyes.
So it's more of a consolidation game that this sort of impact will that there is a downward pressure for entry level products, and I guess from someone that once told me that if you're a if you're a brand, you either have to be a jewel or you have to be scaling. And I think
Mm.
that that's something that brands in the cycle, their moat needs to be either really strong or you need to be scaling.
Yeah, I think that's a really good point. I mean, I think I, this is kind of the idea of kind of trust and brand power. I think goes a lot further too than we recognize. I'm not going to be overly surprised if we start to see really good bikes out of countries in Asia where we're traditionally not used to seeing bikes, depending on what the tariff thing, how that goes. There's not a lot of IP, especially on the mountain bikes side, that's protected anymore.
Right.
So it's like, and we've kind of settled on what is a good design, what is good geometry, blah blah blah. Like a lot of these things that used to be pretty tied up with one brand or another just aren't anymore. So then it's like, all right, well, would I buy that bike off Alibaba or AliExpress? He looks kind of good. Well, no, you don't trust that bike with your life, frankly. So trust is going to matter a lot too in all of this. I don't care where you're playing, but then there is this, one of the best businesses of all time, if not the best, is LVMH, the luxury goods provider or purveyor of goods. They sell basic stuff, relatively speaking, for ridiculous margins. So that does tell me that if you're a Moots or something like that, doing really high-end stuff, bespoke stuff, you can easily charge what you want to charge if you've built that trust, that brand identity, that kind of feeling of, oh my God, that to your point, that's a jewel. That it really does look like some of these high-end bikes literally look like they aren't even to be ridden. I would still ride them, but you get my point. They're works of art. And I think that part of the industry will actually stay pretty healthy. The key to that part of the industry, I think, will be, solopreneurs or small teams leveraging a lot of new software and hardware tools that allow them to do more with less. That's going to be vital in what you do.
Look, man, I'm seeing Chinese companies come in. If you go and you look at like Velotrick is one that comes to
Hmm.
mind.
Hmm.
Um, they are so good at operations. It's just scary, man. Like their product pages, the e-com side of things, like they like from an just from a digital standpoint, like they're light years ahead. And we'll see how the old guard reacts. The value and Europe and the heritage, and the fact that I mean brands will continue, there is this the centricity of cycling, especially road cycling, Europe centricness of road cycling. I find that hard to kind of dislodge, but man, these Asian brands are coming, and they're coming fast.
Yeah, I don't know if you've had the chance to read the book Breakneck. I don't expect that you have, but it really opened my eyes with respect to Chinese culture in the modern era and how engineering forward they really are.
Oh
And
God,
and
yeah.
as a result of my, time kind of studying this, not like a ton, no expert by any means, I just came away with this belief that it would be silly to think that, especially on the e-bike side, that China doesn't start to come out with stuff that really just makes you scratch your head and go, oh my God, how are they able to offer that much for that little of a price?
Yeah, look
Tariffs
at
are going to have an impact domestically for me. In Europe, totally different story. And I don't know if you've heard of these dark factories, but effectively there are factories making complicated goods in China where they literally don't even turn the lights on because it's all robots.
oh wow.
And so you take robots, they're ahead in robotics, their AI teams are cooking, as the kids say, and their price of electricity is plummeting. You put those three things together, and I think that sets the stage to products coming out of Asia, China specifically, that, like I said, are just better and for a better price. So,
It's it's going to be
we'll
hard.
see.
It's going to be hard, and I think this isn't anything new. It really isn't. I mean,
True, true.
it's nothing new. But yeah, like they're coming, and they're coming fast. Like the barbarians are at the gates, so to speak. And again, like I said, time will tell. How much market share they begin to peel away. Amflow is chipping away
There you go. Great example.
quickly. But we'll see. Like I said, the market, Europe and the U.S. They have such still so much weight behind everything. But yeah, this is
Well,
this
they
has been this has been a really fun conversation, man. And I'm really glad I got to sort of color outside the lines a bit from my normal content, because typically it's kind of a founder story or a
sure.
manager story. But this was fun, man. I really appreciate you taking the time. Before we go, if people want to reach you, if they want to come and And if they want to find you, where's a good place that they can find you?
Yeah, good question. You can just Google my name, Jeff Brines. You'll find my Substack pretty easily. I post to YouTube intermittently. You can again find me linked in there too, Jeff Brines. Although my dad has the same name, it's pretty easy to tell us apart.
Okay.
And I'll just give you my email address. I welcome anybody that wants to send me an email for any reason whatsoever. It's jeff.brines@gmail.com. Pretty easy.
All right, man. Well, thank you so much, and happy to have you on. And hopefully, maybe we can follow up in a couple 6 months or so, and take the market temperature.
That'd be great, Wyatt. Thank you so much.
Okay, man. Take care.
Yeah, bye.